Ladies and gentlemen, good morning and welcome to earnings call of Equitas Small Finance Bank Limited. Financial performance of Q2 FY26. We have with us today Mr. P.N. Vasudevan, MD and CEO, Mr. Sridharan N, CFO, Mr. Jagdish J, Head of Assets, Mr. Murali Vaidyanathan, Senior President and Country Head, Branch Banking, Liabilities, Product and Wealth, Mr. Gopal Krishnan G, Head Treasury, Mr. Suresh, Head Strategy and Business Intelligence, Mr. Sundaraman D, Head Investor Relations, Mr. Abhishek, Specialist Investor Relations. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. P.N. Vasudevan. Thank you and over to you, sir.
Thank you. Good morning, everyone, and thank you for taking the time to join this call. Let me start with a few staff-related changes. Dheeraj, who was handling our investor relations and strategy, is moving on after about 10 years stint with the bank. A big thanks to you, Dheeraj, for your valuable contribution to Equitas, and our best wishes to him as he moves on to new opportunities outside of the bank. I am pleased to introduce Suresh, who has been elevated as Head Strategy and Business Intelligence. Suresh has been with the bank for over 9 years. Initially, he was handling strategy for assets, and for the past 7 years, he has been driving strategy for our liability division. In his new role, he will be responsible for strategy and business intelligence for the bank. And Sundaraman, who was supporting Dheeraj in investor relations, will now head the same, supported by Abhishek. I am sure many of you might have already met and interacted with these two gentlemen. Now let me come to the business of the bank. I would like to take this up in 3 parts, namely, 1. Are there sufficient indicators to show whether the stress we have been experiencing over the past 4 quarters is behind us? Second part of my comments would be, what are the key internal drivers that we have in place to deliver consistent and quality growth over the coming years? And third, what's the external market demand and potential? Let me take up the first part, namely whether there are sufficient indicators to show whether we are out of the stress seen in the recent past. The stress was principally coming from the microfinance portfolio, with micro loan against property, MLAP, specifically in Karnataka, adding to the stress in the last 2 quarters. In microfinance, at the industry level, we see many positive trends like, 1, the overall loan outstanding at the sector, which was about 4.4 lakh crores in March 24, came down to about 3.75 lakhs in March 25, and further down to 3.5 lakh crore in June 25. This indicates the willingness of the players in the industry to show restraint in growth to enable more focus on quality of lending over the last year and a half. The second indicator I see is that the percentage of customers at the sector level who had 4 or more lenders was about 22% in March 24, which has come down to 12% in March 25 and further down to 10% in June 25. And lastly, the collection efficiencies reported by almost all players have shown market improvement over the last few months, including in the state of Karnataka. While these are positive trends at the sector level, at Equitas level also we see many positive trends. While our X-bucket collection efficiency has been consistently moving up, other parameters such as slippage from X to OD bucket and the 1 to 90 bucket size has been consistently coming down. Jagdish, in his opening comments, will be elaborating further on some of these trends. In sum, we believe that the stress in microfinance, both at the sector level and at our bank level, has come down to a very acceptable level, and we expect this product to trend towards normal levels of profitability from the 4th quarter of this financial year. As far as the stress in MLAP is concerned, It was a two-quarter issue that we saw largely coming in Karnataka as a fallout of certain localized events. We now see the trend reversing in October month. We now see the trend reversing with October month seeing the best collection efficiency. Given that these are basically secured loans with very low to middling LTV, while there could be a timing factor on NPA and provision, the ultimate loss is likely to be low. Historically, for your information, our loss given default from small business loan is practically nil, given that our recovery from GNPA from small business loans is about 105% of the principal. Now I move on to the second part of my opening remarks, namely, what are the internal drivers which we believe we have in place which would help us pursue robust growth in the coming years. As can be seen in our investor presentation, the CAGR of advances for the past 3 years ending March 25 is about 23%, and deposits, the CAGR for the last 3 years is about 30%. Over the last 20 years of Equitas in existence, we have recorded an over 20% growth in almost all the years, except for a few years which had some black swan events during that time. In terms of drivers, our product range in the asset side is fully in place, be it small business loans, vehicle finance, or affordable housing finance. As mentioned in the first quarter investor call, we are strengthening the distribution of these products both in terms of strengthening the sales and collections team and making the products available in more of the existing branches. Jagdish would again give an idea on this. Gold loan, which was the only product absent for a long time in Equitas, we commenced that in over 200 liability branches recently and have built a book of about 400 crores. We are now going to introduce this in about 50 asset branches, and over the next few quarters, this will be made available in most of the asset branches also, finally giving a fillip to our gold loan book. On deposits, over the past 9 years, we have put in place almost all the products and services that a typical depositor may look for from a bank. Having done this, we believe we are in a position to engage depositors meaningfully over a wider range of products and services, strengthening the relationship in the process and enabling us to reduce our interest rates over time. Murli will talk about the rate reductions that we have been carrying out and its impact on the cost of funds, and also his strategy on deposit mobilization to support the overall bank's growth. I now come to the last part of my opening remark, namely the market potential and demand. As per a recent RBI report, the overall banking sector's credit exposure to the MSME segment in the country is about 32 lakh crores. This is as of March 25. Out of this, the banking sector's disbursement, I am saying disbursement to new to credit, NTC, MSMEs, for the last year, which is the year 24-25, is about 1.7 lakh crores. Okay, I repeat that. The overall banking credit exposure to the MSME sector in the country is about 32 lakh crores, and last financial year, the disbursement to NTC, MSME units, by the entire sector put together was 1.7 lakh crores. Out of the above, Equitas contributes about 0.7% of the overall credit exposure to the MSME segment in the country. However, when it comes to new to credit disbursement for the year 24-25, our disbursement represents about 5% of the total banking sector's disbursement, clearly showing our dominant presence in the NTC MSME segment. Further, SIDBI has published a report titled Understanding Indian MSME Sector Progress and Challenges on May 13, 2025. In this report, SIDBI estimates the total unmet credit demand from the MSME borrowers in the country to be about 30 lakh crore, which is almost the same size as the current banking sector's total exposure to the MSME sector. Similarly, there are reports indicating equal levels of unmet credit demand in the affordable housing finance sector also. The segments in which Equitas operates, as can be seen above, has a very high level of unmet demand and potential. At Equitas, we have established over the last 12 to 15 years strong domain knowledge and capability to address the credit needs of borrowers from these segments. combining the internal drivers that we have already put in place over the last decade and more, and the external demand and potential, we believe Equitas is best placed to deliver consistent and high quality growth over the coming years. With this, I would now like to hand over to Sridharan, CFO.
Good morning, everyone. Thank you for joining us today for the Q2 FY26 earnings calls of our bank. I appreciate your continued interest and support. Let me take a few minutes to walk you through the financial performance for the quarter, while most of these details are also available in our investor presentation. We reported a net interest income of 774 crores and other income of 224 crores, bringing the total net income to 998 crores for the quarter. The yield on advances adjusted for IBPC declined by 33 basis points on quarter to 15.73%, primarily due to a reduction in the microfinance mix. Our net interest margin stood at 6.29% compared to 7.69% in the same quarter last year, reflecting the contraction in the microfinance portfolio. The bank reported a PAT of 24 crores for Q2 FY26 as against a loss of 224 crores in Q1 FY26. Return on assets and return on equity were 0.18% and 1.65% respectively. On the cost front, operating costs remained flat sequentially, supported by a 5% decline in other operating expenses. In terms of asset quality, gross NPA remained stable at 2.82% and net NPA 0.95%, and credit costs have significantly improved to 2.16% in Q2 FY26 from 6.48% in Q1 FY26 and 3.72% in Q2 FY25. Our provision coverage ratio remains healthy at 66.93%, and we expect the credit cost to taper down by Q4 FY26. During the quarter, we have sold 216 crores of NP assets from our secured portfolio to an ARC, Asset Reconstruction Company. Moving to the advances book, gross advances grew 9% year-on-year to 39,123 crores. While the microfinance portfolio contracted by 40%, our non-MFI book grew by 17% Y-on-Y, led by 17% growth in small business loans and 43% growth in used car finance. Disbursement for the quarter stood at 5,380 crores with strong momentum in secured segment. On the liability side, total deposit grew 11% Y-on-Y to 44,094 crores. Our CASA ratio remained stable at 31%, and retail deposits now constitute 75% of our total deposit base. As of September 30th, 2025, our capital adequacy ratio stood at 20.74%. In July 25, we successfully raised the second tranche of 500 crores in Tier 2 capital, further strengthening our capital position. With this, I hand over to Mr. Jagdish.
Good morning, everyone. We have closed the quarter with gross advances of 39,123 crores, reflecting a growth of 9% year-on-year and 4% quarter-on-quarter, which is driven by a healthy uptick in our disbursements. Let me walk through to some key highlights. Microfinance disbursement have resumed this quarter, helping us to maintain the MFI book at around 10% of overall advances mix. Disbursements in Q2 financial year 26 surged 156% quarter-on-quarter, reaching 682 crores, up from 266 crores in quarter 1. On the non-MFI front, we have delivered our highest ever quarterly disbursements, totaling to 4,700 crores in quarter 2, which is a 20% growth in year-on-year and 45% growth in quarter-on-quarter. Our non-MFI secured book now stands at 35,730 crores, marking a 17% year-on-year growth. Within our small business loans, which is a flagship product, the micro LAP saw a robust 39% year-on-year growth. And vehicle finance which grew by 10% year-on-year to 9,800 crores. In that, both used commercial vehicles and new commercial vehicles shown a significant growth. Used commercial vehicles at 25% year-on-year and new commercial vehicles, used cars at 43% year-on-year. Our strategic focus remains on the used commercial vehicles and used cars. And coming back to housing finance, which has grown at 15% year-on-year and 4% quarter-on-quarter, now at 5,066 crores. And MSE finance, which has grown by 36% year-on-year, reaching 1,851 crores. And microfinance portfolio stands at 3,392 crores, and it is expected to grow, driven by our improved disbursements in the coming quarters. And coming back to the yield and asset quality front, the yield on gross advances declined by 33 bps quarter-on-quarter to 15.73. This is primarily due to the lower contribution from the MFI mix. On the non-MFI yields, it remains stable at 15%, underscoring the strength of our secured portfolio. Our asset quality continues to improve. The net slippages reduced to 3.78% in quarter 2, down from 4.77 in quarter 1. In value terms, the net slippages reduced to 355 crores, down from 453 crores from Q1. The credit costs show a sharp improvement to 2.16 compared to 6.48 in Q1 and 3.72 in quarter 2 financial year 25. On non-MFI credit cost, which stands at 1.01%. And coming back to the microfinance, where the stress, what we have been seeing in the past 3 to 4 quarters, which is coming to the normalcy, where I would like to point out certain trends on the microfinance performance. Our expected resolution in Q1 is at 98%. And as on September, it has improved to 98.6. And the last 6 months disbursements, if you look at our expected resolution, is at 99.52. And the book of the last 6 months disbursement is close to 27%. The more important indicator is on the fresh overdues, which has been flowing into the delinquency bucket. In the month of April, we have a fresh OD of 97 crores. But in the month of September, our fresh OD flow is only 30 crores. And in the month of October, it drops down to further to 24 crores. So these are the indicators which shows that in the coming quarters, we can see the normalcy in microfinance. In addition to that, we also covered CGFMU of 27% on our overall book, which will increase to 50% by Q3. And we are looking at a growth of close to 15 to 16% in the current financial year, and looking forward for a growth of 20% on the next financial year. And there are certain strategic initiatives which we have taken on various products, which I will give you a brief description. In vehicle finance, the used car segment, which has been growing at 43%, we further want to grow at an higher rate by focusing on 100 high potential existing branches, with ensuring focused execution and accelerated growth. And AHF, the affordable housing, currently we are operating at only at 70 branches. And in Q3, we are expanding to the additional 30 existing asset branches in Tier 2 to Tier 5 towns. And further expansion of 120 branches will be done in the next financial year. As MD pointed out, gold loan we are going to offer in our 50 asset branches in H2 financial year 26, and another 150 branches we will be adding in the next financial year from our existing set of asset branches. So with all these initiatives, we can look at a growth of 20 plus year-on-year growth from the next financial year. Thank you. I will hand it over to Mr. Murali.
Good morning, all. Just to give you a snapshot of what happened, we have grown deposits at 11%, and RTD grew by 11% year on year, and CASA compared to last quarter we gained more or less flat, but we gained still 1%. Our primary driver is how do we enhance customer stickiness through relationship management, so that, as our MD mentioned, over a period of time, the differential between us and the bigger banks in terms of cost of funds, how do we bridge it? That's the journey which we are into it. This year, during Q1 and Q2, we have done 3 rate changes on SA and TD, and this will be on a continuous basis because our proposition in terms of household segments, today we believe we have investment account, we have ASBA, we have a trading account, and we are enhancing our relationship channel. Just to give you all a snapshot, 60% of the book is into the premium or HNI segment, which is elite proposition. So we are strengthening that proposition in 2-tier mode. Elite being the mid-level, we are going to launch something called Elite Light, which is going to be anything between mass affluent and HNI. And for HNI, we are going to have Elite as a proposition, and in coming quarter end, we can see Elite Plus as a model which is going to cater to the HNI Plus category. Now, why we are going in this direction? Because we have seen in our book at this point of time, we have 35,000 ASBA customers and 35,000 SIP customers, and we have 20,000 broking accounts, which is actually, when engaged properly, is giving us a much better ATS, RV, and most importantly, the relationship part getting the deepening. And we are also going into the family banking as a route. We have been on this journey for last 6 months, last quarter also. Now we have crossed 25,000 families who are banking with us, and we are seeing close to 4,000 crore of RV coming from there, which means it's not only individual when we started as a saver, as a mode, then we migrated individual into saver plus investor plus trading. Today we are saying that along with investor and trading and broking account, we are going to have family banking as a key proposition. With Elite Plus and Elite Light coming in, this is going to be one primary driver where multiple products and absolute yield at the customer level is going to only enhance because the bouquet of products through the relationship management and virtual RM is given. This is one approach. Second approach, if you see in our presentation, is NR segment. Now that AD1, FCNR and inward remittance, which has gone live, outward and prepaid forex should be in next 3 months gap. We will have the entire suite of products for NR. So to make NR proposition and NR affluent customer coming in, we have launched.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.